Over a 17-year backtest, this simple mean reversion trading strategy achieved a win rate of 87% while producing an equity curve that looks like this. All without the use of any indicators, but using a powerful engulfing or outside bar as the trigger. So in this video, I'm going to show you how I find these high win rate strategies while keeping things nice and simple at the same time. Whilst these high win rate trading strategies don't generally produce the most overall net profit, many traders, possibly like yourself, prefer to win more trades than what they lose. And this strategy does exactly that. It buys into short-term weakness. It's very good at identifying turning points in the market. So when we buy into weakness, generally the market quickly turns around, rallies, gives us a chance to take some profit. And of course it does the opposite for short trades. Firstly, I'm going to show you the trade setup and how I use these engulfing, or sometimes called outside bars, for the trade triggers. And then I'm going to walk you through each stage of my testing. In the first stage, it's a fairly broad test. I'm going to be using the same strategy, testing it across multiple pairs. I've chosen 28 of the most highly traded Forex pairs to test on. If and when we find some individual pairs where the strategy shows some promise, then I'll select them and move forward, looking into more detail, running some in and out of sample testing on them. So let me show you on the charts what to look for to trigger one of these trades. Okay, so how do we trade this high win rate engulfing bar setup? Well, it works on the daily bars, or 1440 minute bars, and I'm using a custom session. If you've seen some of my other videos, you'll know that I often test using a custom session. And all that is I've changed the opening time of the daily bar from around 1700 to 1830. I've delayed it about 90 minutes, which in reality, when trading live, that will avoid some of those wild spreads that we can see in the Forex markets. But for testing purposes, you won't notice much difference between using just your regular session or this custom session, which I'm using. So number one, let's identify an engulfing or an outside bar. And I'll show you what they look like if you don't already know on the chart in a moment. Number two, if the close is the lowest close over the last 5 bars, then we buy next open. And opposite for short, if the close is the highest close over the last 5 bars, then we should sell short next open. So we're just looking at 2 conditions. We're looking for an outside or an engulfing bar, and then either the lowest or the highest close over the last 5 bars. Trade exits, really easy. Number one, this is our main exit. We're going to exit after n bars in the trade, and we're going to keep this at 3, but later on we might adjust it. So only after 3 days in the trade, at the end of the session at the close, we look to see if we're in profit. If we're in profit, we use the bailout exit, which means we're going to get out on the next open. If we're not in profit, then we leave the trade running and we check 24 hours later at the next close. If we're in profit, then we do exit. If we're not, we leave the trade running, and so on. And number 2 is our stop and reverse, which we won't use that much on this strategy, but it is there. That means that if we're in a long trade and we still haven't exited for profit, or it's not 3 days in the trade, and we then get a setup to go short, we will exit the long trade and take the short setup entry, and vice versa. So I've put a note here, most trades are going to be profitable. We know this is a high win rate strategy. When the losses do occur, that can be when it's a stop and reverse, when we've exited a trade before it's in profit, or when there's a gap between the close and the next open. And a scenario might be that, let's say we're more than 3 days in the trade and it's a Friday. We look at the Friday close and we're in profit. Let's say we're only in profit for 5 pips, but that's our trigger to exit the market on the next open. But the next open isn't until Sunday evening. And in that time, the market has gapped more than that 5 pips. And now let's say we're 3 pips in the negative. That's where we will take a small loss. What we can do though, and I haven't done that in this strategy, but we don't have to use the next open. We can close the trade 5-10 minutes before the session close. And in fact, that would give us an even higher win rate. So looking at some trade examples, the first one is a short trade example. And we've got the highest close over the last 5 bars, and it happens to be an engulfing bar. An engulfing or an outside bar just means that the price engulfs that of the previous bar, which means that the high of this bar is greater than of the previous bar, and the low is less than the low of the previous bar. So the price is outside of the range of the previous bar. Okay, so when we've got that, that's our entry, go short on the next open. So then we went short and we want to make sure we're in the trade at least 3 bars, and then we look for whether we're in profit or not. So I include the first bar, so that's 1 bar, 2 bars, 3 bars. At the end of this bar, we look at the close. Are we in profit or not? Yes, we are in profit. So that's our exit trigger, and then we exit the open of the next bar. Here's a long trade. Again, we've got an outside bar or an engulfing bar. The close is the lowest close over the last 5 bars. So we buy the next open. We're in the trade for 1, 2, 3. We look at the close. Yes, we're in profit. So then we exit the next open. And another one here. But the exits are not always after 3 bars. They have to be in profit at the close, okay? So looking at this one here, you can see that we were in the trade more than 3 bars. Here's our entry bar. It's an engulfing bar or outside bar. The close is the lowest close over the last 5 bars. So we've entered the market, and then 1, 2, 3. After 3 bars, we're checking at the close, are we in profit? And we're definitely not in profit, although the market does turn around. The next bar, are we in profit? No, we're not. Next bar, are we in profit? Yes. Finally, we're in profit, so now we can exit. Okay, so we're in the trade longer than 3 bars, but it's always a minimum of 3. And the same here. You can see that we entered the market, and then 1, 2, 3, we weren't in profit, only in profit on this bar, so then we exit the next open. So I think you'll agree that it's a dead simple strategy, easy to spot the trades, something that anybody can trade. So let's go and have a look at Multichart's Portfolio Trader, where I do the main test on the 28 Forex pairs to see if any of those show some promise with this strategy. Okay, we're in Multichart's Portfolio Trader, and this allows me to run the strategy across many markets at the same time. Firstly, look at the data I've got. I've got from January 2008 through to January 2023. That's our in-sample data. That's our testing data. Once we've found a strategy which we're quite happy with, we can then go and look at some out-of-sample data, and that will be from January 2023 through to, I think it's going to be October 2025. So we've got almost 3 years worth of out-of-sample data to see if the strategy continues to work. So in this stage, I'm going to very quickly run through the 28 Forex pairs, and essentially I'm just looking at high win rates and a reasonable, consistent equity curve. So let's have a look at the backtest. Here you can see that we've got quite a lot of them which are profitable. So let's very quickly look at the equity curves. Australian dollar, Japanese yen. I don't like that equity curve, do you? Aussie, New Zealand's not making much money. Canadian, Swiss franc, that's a reasonable equity curve, isn't it? And if we look at the win rate, that's 82%. Okay, so that's a good candidate. Canadian, Swiss franc. We've got loser, Swiss franc, Japanese yen, not a good equity curve. Euro, Aussie, not great. Looks okay recently. Euro Canadian, again not great, but does look okay recently. Got loser. Euro pound, that's a reasonable equity curve. And again, we've got an 82% win rate. Okay, so that's another candidate. Euro yen, bad equity curve. Euro New Zealand, wasn't very good at the start of the test, but then yeah, pretty good. What's the win rate? 80%. So that's pretty good. That could be a candidate as well. So loser, loser, pound Canadian dollar, not a good equity curve. Pound Swiss franc, not good. Loser, pound New Zealand dollar, not good. Loser, New Zealand Canadian, doesn't make much money. Curve's not very good. New Zealand Japanese yen, not very good. And that's yen, so that's really bad. And US dollar, Japanese yen, again, working okay recently, but generally not very good. So the three which did show some promise, my favourite is probably the first one, Canadian dollar, Swiss franc, and we had euro pound and euro New Zealand dollar. I'm going to move forward with Canadian dollar, Swiss franc, just because I think it's a nice consistent equity curve, especially in the second half of the test. It's looking really good. These green dots show new highs in the equity. So now we've chosen a Forex pair which shows some promise, we're going to have a look at it in some more detail. Although I'm not keen to change that bar delay or the look back period in this test, I do want to see what happens if we do change it. And then we want to have a look at that out of sample data, just to make sure that this strategy isn't overfitted to that initial 15 years of in-sample data, which we've already looked at. If you'd like to see some more rule-based trading strategies, a little bit like we're looking at today, you might like my 22-page Beat the Markets Strategy Guidebook. In that, I outline 3 more rule-based trading strategies. And at the moment, if you find the link down in the description, you can get that absolutely free. So if that interests you, have a look after the video down below. Now, let's go over to multi-charts and look at this one Forex pair in more detail. Now we're in multi-charts and we're going to have a look in more detail at Canadian dollar, Swiss franc. Just talking about the inputs which I chose for the original testing, I purposely chose a fast-ish look-back length of 5 to get me as many trades as possible here on the daily chart. Knowing that I was going to use an additional engulfing or outside bar signal because that's going to reduce the trade count even more. And as for that bar delay before we bail out, through experience I know that it's best to give the trade a minimum of a couple of days to generate a decent enough move. Otherwise we can end up with an average trade value which is just a bit too small, meaning that we're going to struggle to overcome trading costs. Talking of costs, at the moment I'm not using any, but once we have the final strategy with the final full data set, then I'm going to add some in so you can see what effect they have on this strategy. So firstly, in this chart, we've got the same in-sample date range as we've already looked at in the Portfolio Trader. Let me just quickly show you. You can see we've got from January 2008 through to January 2023. The first thing I want to look at is that bar delay, which we've got set at 3 at the moment for the bailout exit. So let me do a quick optimization between 1 day or 1 bar and 10 bars. So from 1 to 10 in steps of 1. Looking at the 2D graph. Now this shows us net profit against a bar delay, and I have 3 at the moment, which is here, but you'll see that 2 bars, 4 bars and 5 bars, even 6 bars are all better than my original guess, okay? But what about the percent profitable? Let's look at that. So the red line is the percent profitable, and there's no surprise that the quicker that we exit into profit, the higher the percent profitable. So I'm using 3 here with the percent profitable around 82%. But maybe there is a sweeter spot than 3 bars, maybe it's 4 bars or even 5 bars. Seeing as the profit falls off so quickly after 5 bars, I'd probably stick with 4 bars if I had to choose. But for now, I am going to stick with my original. But I want to do another optimization looking at that look back length. So we're going to leave the bar delay at 3, and then we're going to optimize the look back length from 2 to 25 in steps of 1. Again, here we're looking at the net profit versus the look back period. I was using 5, and again, it's not the best, is it? Nowhere near. 4 is better, and obviously 6 looks like the best. 7, 8, 9, 10, all the way up to 10 is probably better than what I'm choosing. Probably 9 is probably 8 or 9. I think would probably be a sweet spot if I had to choose, looking at this optimization. And what about the accuracy? So the red line showing the accuracy, and it looks like the longer the look back length, I guess the more valid the signal, the better the signal is. We're going to get fewer of them, but the more valid the signal is and the more accurate it is. So me down here at 5, if I was to lengthen that look back length to 6, 7, 8, 9, where I think is probably a sweet spot. It would not only make more profit, but it would be more accurate. So let's bear that in mind. But as we move forward, I am going to stick with my original of the 5-bar look back. So now we know what works better than what I've originally chosen. Let's have a look at some out of sample data. So in this chart, I'll show you the date range. We've got from January 2023 through to the 18th of October 2025. So almost 3 years of data which wasn't included. We haven't seen yet. We haven't seen the results of the strategy on this data yet. So let's see if the strategy has held up. We've got our original inputs of the 3-bar delay and the 5-bar look back. And there's the equity curve. You can see that pleasingly, we have made money into that out of sample period. The percent profitable has reduced a little bit. It's down to 77% now, but still a really high win rate. And in the last chart, what we're going to look at is that data, including the in sample. So we've got in sample and out of sample now. We've got the full date range. So we've got what we've already seen with that in sample with the out of sample added on to the end, if you like. So from 2008 through to 2025. So looking at the back test with it all stitched together, there's no surprise that now our percent profitable is somewhere in the middle between, what was it, 82 for the in sample, 77 for the out of sample. So now it's sort of in the middle. Average trade value of 152 francs. That's on 100,000 units or one full lot. And the equity curve, now you can see that we've got that out of sample bit stitched onto the end. So quite a nice consistent equity curve with a high win rate. And we've got a net profit of 36,000. It doesn't trade too often, but when it trades, it's fairly accurate. Now, out of interest, let's go and change the inputs to what we found looked about the best from our in-sample optimizing. So if you remember, looking at the bar delay, 4 was definitely better, wasn't it? 5 was even better, but we thought maybe 4. And then a look back, we definitely want to go longer. Let's go to 9 and see what happens. Net profit, much more net profit now. We've got 63,000 now. Our equity curve is even smoother. That's really nice. And what about our accuracy? 87%. So that's even better. And our average trade is even much higher. So all round, we can see that those optimized values do work in the in-sample and the out-of-sample data, and they actually work better than what I originally guessed, if you like. The final thing we do just before we move on is add some trading costs, because I mentioned we didn't have trading costs. I'm going to add 6 pips, which is going to be sort of 30 francs in, 30 francs out. So you can see, and you can see it's reduced our average trade value, it's reduced our percent profitable. What's it done to our equity curve? You can hardly see any difference. That's because we've got a decent average trade in the first place. We've got a reasonably large average trade value, and a few pips worth of costs don't affect it too much. That's quite the opposite of what we saw in my last couple of videos, where we were looking at some smaller timeframes, looking at some strategies on 30-minute bars with very small average trades without any costs. Yes, they looked okay. The minute you included costs, they completely destroyed them. So when you start with a decent strategy with a decent average trade, things like the costs and differences, slight difference in prices, aren't going to have that bigger impact as what they would do on a strategy which has a much lower average trade. So we've seen that my original inputs of the 3-bar delay and the 5-bar look back are not the best. However, regardless of that, they have still made money when it comes to looking at the out of sample or unseen data. And those best inputs, which we found by running those optimizations of 4 and 9, also work really nicely in the out of sample data. In fact, they worked better in the in sample and better in the out of sample than my original picks. These days, I'm using a lot of walk-forward optimization when I develop my strategies. That way, I don't have to pick the values which I think are best. I've made videos about walk-forward optimization in the past if you want to learn more about how I do that process. The question is now, with this strategy, is will it continue to have a high win rate into the future? Quite possibly, but we never can tell. This is trading after all. This is why it's so important to monitor the performance of each of our trading strategies to make sure we can detect as early as possible if the strategies are starting to break, and then we can stop trading them. Well, that's about it for this video. Thanks for staying till the end, and as always, I do hope you've enjoyed it, you've enjoyed following along and perhaps learned something. Please let me know in the comments if you have, and consider subscribing for more videos like this one. Anyway, I hope to see you in the next video, but until then, this is Jared Goodwin, and thank you.